We're live.
Hi, welcome to a special live episode of Ilanomics. Just when we thought India was taking a break from announcing financial and economic decisions and announcements to help revive the economy, the Reserve Bank of India Governor Shaktikanta Das convened a special press conference this morning and announced yet another interest rate cut. He also extended the moratorium on term loans, by another 3 months. So this looks like both the fiscal side and the monetary side of the Indian economy are working in tandem to try and keep pushing the economy so that it doesn't get stuck in the slowdown mode and the negative mode. Uh, I have Professor Ila Patnaik joining me from her home because we are doing this on a digital SimSat as we call it. Ila, a surprise decision by the Reserve Bank of India. Or were you expecting it? Considering last week, Finance Minister Nirmala Sitharaman had a series of announcements, and then we thought there was going to be a pause.
I was certainly hoping for this. And in some of those videos also, we talked about how monetary easing is not just the need of the hour, but it also is easier to do. It's less expensive to do than fiscal spend, which is what, part of the fiscal package was about. So this was something that, considering how long the lockdown had gone on, this was something that was on the cards, and I was certainly hoping that something like this would come. And it is welcome that it has come because the lockdown was much longer than what the RBI had anticipated, and I think the economic impact has also been much worse than what was initially expected. So you certainly needed to bring rates down. You needed to extend the moratorium. And I'm glad that, a step has been taken in that direction.
But Ila, we go back to a question and an issue we have discussed and debated so many times in the past on our conversations during our conversations. Uh, it's one thing for the RBI to announce a rate cut, and it's another thing for banks to pass it on, for lenders to make use of those lower rates and borrow. And even now, since the extra liquidity was infused in the last announcement, and also the government, announcing steps to help pump in more liquidity, banks have been cautious. What will change now?
See, lending rates of banks, like for example, EMI, are for home loans, are linked to a benchmark rate. And when the repo rate goes down, the benchmark rate is supposed to go down. And either they are linked to the repo, or they are linked to some of the other rates that are in the system, which are external benchmarks. Now, of course, it is critical that these rate cuts are transmitted to borrowers, because without that, there's not going to be an impact of the step. But hopefully, because of the linking of the rates, the banks will cut rates, and you will find, so they're both pumping in liquidity into the system, as well as indicating through a cut in repo rates, that, as well as the cut in reverse repo rates that have been done, both help in improving transmission. But at this point, I must say that monetary policy transmission in India has been weak. It has been a problem. Rate cuts don't easily translate into rate cuts for borrowers. A lot of financial sector reforms have been on the agenda, but have been slow to go through, like building a bond market, which helps some of the transmission problems to improve, getting a competitive banking system, which helps transmissions to improve. Now, this is not the time to talk about all of them, perhaps, but this is a long-standing problem. The full 40 basis point cut may or may not be transmitted to borrowers, but let's see. Let's hope that it is.
Also, the extension of the moratorium, Ila. What difference will that make? First, we had a 3-month moratorium. Now it has been extended for another 3 months, uh, which obviously indicates that the Reserve Bank is worried about the state of the economy, and it has said as much, where it says, its private consumption has been a big issue. All high frequency indicators are indicating a collapse in demand. Uh, but at the same time, Governor Das said we should have faith in India's resilience. Obviously, the RBI is worried.
Clearly, the RBI is worried. And again, I think that because businesses were not able to function, sales did not happen, production had to be stalled during the lockdown period, this measure was this extension of the moratorium was critical because, when you ask people to repay when they don't have the money, then a lot of the loans would have gone bad and banks would have had to declare them as NPAs and get into trouble. So, you don't want that whole effect to be playing out now when there are enough problems on your plate. So what you do want is to give some breathing time to both the banks, the borrowers, and to let the economy recover a bit so that people have sales, they have money to repay their loans. So I think it was critical and it was necessary.
And the RBI is also now talking about growth slipping into negative territory, the first time it has done so.
Yeah. So I was relieved to see that they're finally acknowledging openly and publicly what a lot of us have been suspecting is going to happen this year, that growth will slip into negative territory. You will notice that the governor did not put a number on the uh, negative growth rate. How much negative would it be? Would it be 5%? Would it be 10%? And I think that's wise because at the moment, it's very hard to say and very hard to forecast how bad the negative growth might be. But it is certainly a relief to see that they're not, uh, fooling themselves into thinking that we are still going to get positive growth, because that is a very, very, very unlikely scenario that this year you'll have positive growth.
We've started to get some questions from our viewers, Ela, and I'll take one from Ishank. It's related to what I asked you at the beginning of our conversation. Will cutting policy rates alone help the economy when the banks are not extending loans, not even to middle classes so easily? So why are we stuck in this vicious cycle? And does that require, or will the central government intervene much more forcefully to see that this helps?
Let me say that if they had not cut rates, okay, uh, so loans would not have been repriced. Okay, in these times of difficulty, it would not have become cheaper to repay loans. Now, of course, you don't have to repay now. So both issues. One is the interest rate that you pay, and the second issue is when do you have to pay it. And if banks had forced businesses, households to repay the same higher interest rates, and at the same time, I'm sure then the criticism would have been, why did you not cut rates? Okay. So, of course, times are difficult. Yes, banks are not extending new credit. In fact, many borrowers will not be wanting new credit because you don't want to take credit, do an investment at a time when there's such huge uncertainty. So I think the logic of this at the moment has to be seen as that this is something that will help reprice loans. And if loans get repriced, it will give relief to people who are currently in difficulty. So I would say that don't look at how new loans may not be given out because of this, but certainly look at how loans will get repriced, and that will help borrowers to some extent.
When what about the point Ishank has made about the need for the government, or whether the government will intervene more forcefully? Can the government do anything at
Intervene,
all?
intervene in terms of the bank's
Transmissions
lending.
and allowing banks or pushing banks to lend more easily.
So while the government does do some of these things very often, they're not usually very effective because we have fundamental problems with our banking system and fundamental problems with the financial system. So when you have a public sector bank dominated system where public sector banks feel afraid to, many managers feel afraid to lend, they're scared of the agencies, investigations, if the loan goes bad, and so on. At this moment, if the government does try to tell banks to lend, usually it'll be banks will find a way to do things which look like, yes, we are going ahead and lending. Maybe some lending will increase to their existing borrowers. We saw a lot of that happen with the Mudra loan scheme when governments give targets to banks. So, to answer your question, will it help? Well, maybe a little bit, yes, to some people. But fundamentally, what should the government do? Start initiating reforms. Maybe they won't have an effect today, but this crisis is not going to go away tomorrow. I think it's here to stay for maybe a year, maybe 2 years. And of course, we'll recover. There will be better times. But in the meanwhile, if you want to solve that problem of why do banks not transmit lower repo rate into lower lending rates, then you need more fundamental reforms than just the government issuing directives to public sector banks and just telling them that they have to do this.
Ganesh Kumar Samatham has a simple question. He's asking us, Ila, whether the rate cut will bring down the interest rates charged on home loans as well as business loans.
Yeah, so I spoke about this a minute ago, that if that home loans or business loans, the loans that banks give, are linked to benchmarks. So in 2019, the RBI had come up with had issued a circular that they should be linked to an external benchmark rate. And now, depending on which that benchmark rate, suppose that benchmark rate is the repo or gets influenced by the repo. So then when the repo goes down, the rate goes down.
This question about government intervention has been posed very differently by, just a moment, Tarush. Tarush is asking us, why doesn't the government just borrow from the bank and distribute the money to among people?
Um, the government anyway borrows a lot from the bank. Or the entire fiscal deficit is government borrowing from the bank. In fact, a lot of the distribution that is being done, has been done, is not because we've all been paying taxes in these 2 months. The system didn't have the ability to pay much taxes. It has pretty much been on borrowing. So effectively, what's happening is not very different from government borrowing from banks and distributing money.
Uh, there's a question about inflation. We've tackled this question about inflation even in our previous live episodes when we were discussing the finance minister's announcements. This is from a handle, I presume the name of the handle is Punjabi Guy 78. He's asking us, Ila, doesn't the rate of interest being less than inflation suppress demand additionally?
So I think our expected inflation should actually be lower than what we had earlier expected and anticipated. So we'll have some positive real interest rates. I mean, so he's suggesting that the real interest rate is negative.
Yeah.
Yeah, he suggests. But my sense is that actually inflation will be much lower. I know that the RBI said that inflation will be high, relatively high in the first half of the year, and then lower in the second half of the year. Maybe that's the case because of some supply constraints and some conditions in the market, supply shortages, which could lead you to some specific items in which interest rate, in which which prices are higher. Okay, but overall, the general level of inflation, when we have so much of a demand fall, is, I think, going to be low. So I don't think we should worry that much about, the level of inflation that is going to be there, and I think that's going to be much lower.
We have Parimal asking us a question. Neela, Parimal is a regular viewer. Thanks, Parimal, for watching us and coming back to us with your questions. With the RBI forecasting a contraction, is negative interest rate a possibility? And with real interest on savings dropping to negative, will we arrive at a liquidity trap scenario? That's a significant question.
Well, there are countries which have negative interest rate, but I think nominal. So let's distinguish between a nominal negative interest rate and a real negative interest rate. Okay, so my sense is that if he's talking about a nominal negative interest rate, we are not likely to see that. Okay, in emerging economies, we have not seen that. And in fact, in India, think about it. If you have a nominal negative interest rate, uh, what will that do to your savings? I mean, are you going to save if the bank says, I'm going to charge you money for keeping your money? I'm going to charge you interest. That's what a nominal negative interest rate means. Uh, I don't think that in India, currently, that's where we will head. First, we also have this situation of, it's never very clear how savings respond to interest rates. Still, in a situation like ours, we do need households to save to be able to lend to the government. Uh, all this increased borrowing, this increased fiscal deficit that we are going to see. So my sense is that policymakers are not going to push interest rates, nominal interest rates, into negative territory in India.
And what about the liquidity trap scenario Parimal asked?
So that would be when you are at near zero interest rates and then you keep pumping money in and nothing happens. I don't think that we are there because, of course, as I said yesterday, we don't really have an experience with a situation like this. We've never had a complete shutdown of production, of demand, and of supply. But you know given what we can understand from first principles, I think that this is not a situation where we are going to be in this long-term liquidity trap situation where you keep, you know, uh, increasing money supply.
Uh, Abhay Vishnoy has a similar, simpler question like we had one earlier. Will interest rates on fixed deposits and other savings instruments also decrease?
Very likely, because what banks have to do is to balance their assets and their liabilities and the returns on their assets and liabilities. And if they are going to get less, then they pay out less. They may not happen immediately. The repricing of fixed deposits may not happen immediately, but sooner or later, when there are low interest rates. I mean, you think about advanced economy interest rates that banks give sometimes. What have they been giving in the last 10 years? 0.25, 0.5, 1%, whereas here we get much higher rates. So in a regime with low interest rates across the economy, uh, interest rates on savings, fixed deposits also come down.
Uh, Antikar John has another procedural question actually. He says banks actually deducted EMIs and after a month the amount was credited back into the account. Why did they do that?
I don't know. So I'm not aware of these details and procedures of banks. I think maybe somebody who covers the banking sector in greater detail should answer that.
I can only guess an answer and try and help Ela. What happened was when the announcement was made, some banks had already deducted EMIs for the month of April, I think, or was it March? March, April, May. Yeah. So they had to return that money since the announcement was made subsequent to the EMI being deducted from account. So I think that was just a procedural change. Antika, I hope that answers your question. Uh, Raman Dharmarajan has a question. He's saying, is this the right time to consider Islamic banking? What would be the consequences if both interest rates on deposits and loans are slashed to zero? I think we need to tell people what Islamic banking is in the first place.
So the issue of Islamic banking has been discussed in government and banking and RBI for quite a while. And this was not something that banks particularly wanted to do, because banks have costs. And even when there is Islamic banking, there is some way in which, some mechanism, financial instruments through which you have to find to cover your costs. Because when the bank is an intermediary, it raises money at a certain cost and it gives out loans. Now, that intermediation cost of giving loans, of monitoring them, of doing legal proceedings in case the loan goes bad, and so on. There's a whole function that banks perform, and that function cannot really be performed at zero cost. So banks would have had to find ways of covering their costs. And in the in the discussions that have been held over the years, they were not keen on doing so. So I don't think that at the moment we can switch banks into this new mechanism in which they will have to find new ways, new instruments through which they will have to cover their costs. And I don't think that a time like this, when things are highly uncertain already, will be a time when banks will be ready to move to any such system, or even the capacity of the rest of the government and RBI to find ways of how the intermediation costs will be covered.
Manish Sinha has a very simple, straightforward question. Can India go for quantitative easing?
Uh, Already, India is doing some quantitative easing. When I look at the balance sheet of the RBI, the balance sheet of the RBI is published in the weekly statistical supplement. And if you look at the size of that balance sheet, that has been expanding. So a part of that, a little bit of that is being done. Now, one does not know whether this is a long-term measure or a short-term measure. Eventually, we'll have to wait and see what RBI decides to do.
Another question, again, similar. What is wrong in RBI monetizing the deficit? This is from Jay Wadkar.
Nothing is wrong except that you don't want to use up all your ammunition right away. So what the government tries to do is that, to some extent, it tries to borrow what it can borrow in the market. It tries to borrow from banks because banks are not exactly lending to others. I think that eventually, if we are not able to borrow, and if we are not able to borrow either domestically or get foreign investors to buy Government of India bonds to the extent that we need, then RBI may monetize a part of the deficit. Why would it not monetize the entire deficit? I mean, that would be something that has never been done, and it runs the risk that once we are out of this immediate situation, then forces of inflation could build up again. So it won't be, I don't think that RBI would jump in to start monetizing the entire deficit. It would monetize a part of it as the year goes by. I wouldn't be surprised if up to 1 to 2% of the deficit gets monetized through, either extending the Ways and Means Agreement or through other mechanisms.
Mhm. I'll take one last question, Neela. This is from Parimal again. He's saying if there isn't enough money in the market for the government to borrow, should it push a gold monetization scheme and nudge institutions and households to invest in it? This is a thought that has been discussed in the last couple of weeks that the government should try and mop up some of the gold which Indians have loads of.
Uh, yes, the government should try to do the gold monetization scheme. They may be more successful than they were earlier. At the moment, what we have is the history of how it didn't really work. I mean, one of the things with the gold monetization schemes is that women are asked, mostly women, are asked to put in their jewelry, but what they get back is a gram of gold or 10 grams of gold or a block of gold. Now, my sense of one reason why it didn't work was the emotional attachment that we still have to gold jewelry. We still have to, where it's come from, what it looks like. This was the har that my mother gave me, or so and so. So that scheme of expecting households to put in gold, and then when they get it back, it's a block, hasn't worked. So we need to think of how one can make that work if that scheme is to be brought back, and or maybe in some new design, or what needs to be done.
To conclude, Ila, one final question from me. If you look at what the government announced last week, the 5 tranches, and what the RBI has done today, that was fiscal, this is monetary. If you combine the two and look at the fact that the lockdown is in its fourth and probably the final, most relaxed phase, how do you summarize what has been done so far for the economy?
I think these are steps in the right direction. That you did need to ease liquidity, you did need to do monetary easing, cutting interest rates, moratoriums, increase fiscal spend, give credit guarantees. Only a very small part of uh,
Yeah, go on, Ila.
somebody else has signed in. So it says I've been signed out. So I'm not sure that this is live anymore. But anyway, let me continue.
It is live. I can see it's
Okay.
live.
Okay, fine. Then sorry about this. Uh, I think those are steps in the right direction, and that we'll have to wait and see if more is needed, because I don't think the story has played out fully. I think that both in terms of COVID, of disruptions of supply chains, of disruptions of more manufacturing, we have to still see, we managed to postpone the spread of the virus by at least 2 months. But I think, though of course today we are in a better position than we were in terms of how we handle it, but I think more steps may be needed as the year unfolds.
Like you said in your column today, and also the earlier video we recorded, there are so many unknowns that everybody has to keep their powder dry and wait to be able to intervene again and maybe again as the situation unfolds. Thanks, Ila, for joining us through remote digital connection.
Thank you.
Thank you, viewers. Thanks for watching us on this special live episode of Ilanomics. Please do continue to read ThePrint.in and watch our videos and subscribe to our videos on the YouTube channel. Thank you very much and have a good weekend.
Thank you. Bye.